You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everyone, and welcome to the Infinite Banking Mastery Podcast. Thank you for being here. So today I want to talk about the money that we are willingly handing away on a regular basis. And you're thinking, what is she talking about? What does she mean? Well, what I mean is that the money that we are willingly handing away to banks every single month. That's what I'm talking about. So have you ever considered this thought that you are happily handing over money to banks all the time on a regular basis, every month? If we reference Nelson Nash's book, Becoming Your Own Banker, he gives an example of what the finances look like for the, quote, average American. For those of you who have this book, you can reference or go to page 17 in the book or look at it later. Of course, this example that I'm about to go over is just that. It's just an example because, of course, not everyone's situation is going to look like this. So in this scenario, Nelson paints a scene of a young man who just makes a very modest living. He has a chart on page 17. In this chart, he is showing the annual pattern of spending for this average American, and he's saying that this person is spending 20% of his take-home dollars on transportation. He's spending another 30% of his take-home dollars on housing. And then 40% of his take-home dollars is being spent on living expenses, such as clothing, groceries, maybe a boat payment or something, charity. So all the other living expenses are in that category. And then he allocates 10% for the average American that they're saving. He says that the average person is saving 10%. Now, in this book, he does say that actually it came back as 45% being spent on living expenses and 5% being saved, because back then and even now, the savings rate has not been 10% for the US. There were times when it was higher, but certainly the norm is not as high as 10% for the average American. So now that we know the categories and the amount that he's saying is being spent just on the overall category, let's take a look at the interest that's being spent on each of those payments. So on the transportation, where he's spending 20% of his take-home dollars, about 5% of that is going away in interest on the car payments. And then for the housing, we've got another 25% going away in interest. Now, remember that he's spending about 30% of his take-home dollars on the house payment, and 25% of that is going away in interest. So then on living expenses, we have another 5% going away on interest for those things. So that would be credit card interest or, again, the boat payment. He's got a loan for the boat, so he's got interest there. And so the average person is spending about 34.5% of their take-home dollars on interest. So that means that 34.5 cents of every dollar spent, we are willingly handing away to banks in the form of interest. Now, a lot of advisors out there would look at this scenario and say, oh, well, we've got 10% going into savings. So let's have our conversation about what we could invest in, what we could put our 10% into, why these investments are better than these investments or whatever it is, but are completely ignoring the 34.5% that we are willingly handing away. So if we actually could just stop bleeding out all that interest, we already would be ahead by 44.5% before we invest in anything. So Nelson likes to use an example of a pilot flying a plane to better describe what's happening here. He says, because he was a pilot, he says, if you had an airplane that can fly at 100 miles per hour and you take off and get up in the air and you fly into a headwind of 345 miles per hour, you're going backwards at 245 miles per hour. In this scenario, the 100 mile per hour plane represents the 10% in savings that we're trying to achieve. And we're flying against a headwind, and that's the 34.5% that we are handing away in the form of interest that's working against us. And so he says, you'd be better off to land your plane and wait until there is no headwind, and then you can take off and be flying your plane at 100 miles per hour. And at least your 10% savings, you're actually able to save, and that's actually working for you. And he says most people then they might think, well, if I could do any better, maybe I can get to 105 miles per hour, or this is the best it gets. This is the best I can do. But he says, no, that's not the best you can do, because actually you could land your plane and wait for that headwind to become a tailwind. And now that tailwind is pushing you at 445 miles per hour. So it's helping you along. And so that's the same thing we're talking about here. That getting that help of that redirecting that interest to paying yourself, paying your own banking system, that would be best to get that headwind working for you and become a tailwind instead and push you forward. And so what he's saying is basically about 95% of Americans are doing the equivalent of flying into a 345 mile per hour headwind. And in the financial world, things are always compared to what everyone else is doing. So the difference between what we're teaching and what everyone else is doing is a difference of 690 miles per hour. So, of course, in the world of flying planes, the environment can't be controlled. But in the financial world, you can control your environment by controlling the banking equation in your life. By doing this, you would be creating that perpetual tailwind for yourself, just launching you forward in your own financial world. So kind of to give you a story about being in control and controlling your own financial world, like how is this possible that I could control the banking function of my life? I'm going to give you a short story about a client that I've worked with. And so this person, he wanted to buy some property. And so he said, hey, I need $100,000 out of my banking policies. And so we got the money out and he went out and purchased this property. And then he said, you know what? Finances are tight. I just bought this property. I have this new mortgage payment and I've got all these things going on. I don't want to start a repayment yet to the life insurance company because it's just tight for me right now. I am going to pay myself back and I am going to pay myself back with interest, as Nelson would insist. But he just was having a tough time at that moment. And so we pushed it off and he just didn't pay anything back to that on that money he borrowed from the life insurance company for about a year or so. And so I'm just going to ask, what bank would allow you to take $100,000 loan and then just pay nothing for a year? Anyone, anywhere, is this a possibility? No, you take a $100,000 loan and you got to pay it back. You have a payment right away. And if you don't pay it, then you lose the loan, you lose the property, they seize your assets. And so that's just one of the ways where you are in control by using your own banking system, is that if you stuff it and you have enough money in there for whatever the purpose is, whether you want to buy real estate or whatever it is you want to do, you want to buy some investments using your banking system, you are in control and you can control the payments to yourself. And you can decide if you're going to pay yourself back with more or with less, or pay yourself all at once, or pay it over time. So we eventually did, after that year, we did get together and create an amortization schedule. And we, according to the amount of time he wanted to structure the payments to pay himself back and pay off that loan, we did all of that. And he created an interest rate that he wanted to pay himself. And so it all worked out great. But for that moment, he had the opportunity to only pay on the loan for the new property and not have to pay on the life insurance loan, which again, you can't take a loan from anyone or any place, any bank, and not have a monthly payment. So that's one of the examples of being in control. And in the meantime, while you're enjoying the control of your own banking system, the cool thing is that when this person took out this $100,000 loan to buy this property, that money was still earning the entire time. So it's not like if he took it out and now it's not earning for him. It is still earning for him as though the amount was never touched. as though he never moved the money, because he's not withdrawing it from his account. He's borrowing against it as collateral, just like the equity in your home, or just like if you had a CD at a bank with $50,000 in it, and you went over there to get a loan for a car, and they said, sure, you have money here with us, and we see you have property and things like that, so we'll trust you for that loan. Great. But they don't go into your bank account, your CD account, and take out the 50,000 and loan you that or give that to you. That account continues to grow. It's the same thing with the life insurance company. You have your money, it's housed there. When you take out a loan against it, it's still there as your collateral. It's not touching that. So that is able to continue to grow as though you never touched it. And that's part of the magic of infinite banking, because this allows your account to snowball and get bigger and bigger and bigger, because it never shrinks, even while you're able to use those funds for other investment purposes or for anything else that you see fit, because it's your pool of cash to use for however or whatever you need. Now, I want to back up a bit to the beginning of the illustration about the average American, where I was talking about how this person was spending about 30% of his take home or after-tax dollars on housing, and 25% of that was going away in interest. And so I just want to clear that up and kind of elaborate on what I'm talking about there. What I'm referring to and what Nelson's referring to is really those first maybe 5 to 10 years of the mortgage, where you're paying such a high majority. Most of that money is going to interest. So a tiny, tiny bit is going to your principal every month, and the rest is going to interest. And so, as you pay your mortgage, the tables kind of turn, and eventually you're paying more towards the principal and less towards the interest. But in the beginning, the majority of your house payment is interest. And so a lot of people in those first 5 to 10 years, they refinance because a better rate comes out, or they want to move, and then they end up starting this nasty 5 to 10 year time period over again. I don't know if you've ever taken a close look at your mortgage statement that you receive, or your online statement, or whatever. Have you looked at those beginning years, or looked at it in those beginning years when you're first buying your house, and taken a good look at just how much of that money is going to interest versus the principal, or even on the amortization schedule you got from purchasing your house? It's ugly in the beginning. That's just the truth. So for those of you who have purchased a house, when you're signing for your house and you're signing that big giant stack of papers, and in that stack of papers, there's this section where there's these 4 boxes, and it tells you, what your interest rate is and how much the house is and how much you're going to be financing. It breaks it all down there. And so I don't know if you've looked at that or really thought about that, but usually the amount of finance charges that you're going to pay is enormous, like maybe the same amount as your house is costing, or close to it, or maybe more than what you're buying the house for. And so when you look at that and then you consider your interest rate, like let's say at 5% or something, what's the relation there? Because if I'm paying for my house and at the end of the day, I'm going to spend 50% of the total cost of my house in interest, how does that relate to 5%? It's just hard to see the connection there. So I just looked up my own documents from when we first purchased our house, just so that I could see this and use this as an example. So the interest rate on our house when we bought it was 6.678. Now, a year or two ago, that would have been horrendous because rates were so much better. But now it's kind of on par with what's going on. And then I looked at the finance charge. The finance charges were $483,238. So that's me paying, the house cost $377,988. And the interest that I would pay by the end of 30 years would be $483,238. So that's more than I pay for my actual house. That's more than the cost of my house by 123%. So I'm not sure where the 6.6% is coming in there, but I'm paying 123% worth of interest as compared to the amount I'm buying my house for. So that's why Nelson says it's about the volume of interest, not really the interest rate. It's the volume that you're paying, because the volume here is massive as compared to the interest rate. It sounds not great, but not terrible, but it's about the volume. So now we can take it one step further and look at the payment that I'm making to the bank every month for this. So the payment was about $2,200 per month. Now, the bank will be receiving this $483,000 in interest. But if you think about it, is the bank really sitting around there just excited and waiting for year 30 when they finally collected all their interest and yay, we made $483,000 on that house? And are they just waiting around for that win? Because that is a win for sure. No, they are taking your monthly payment, loaning it out times 10, and earning interest on it all along the way until you pay off your house eventually. So if we just pretend that they're not fractional reserve banking with this money, and instead they're just finding a way to earn 5% interest, even just 5% on your $2,200 a month payment or on mine, that means the bank ends up earning over $1.8 million on the house that I'm buying by investing that money, by actually wrapping my payment up with interest every month and selling it to someone else. So they are taking my payment, wrapping with interest, selling it to someone, making money on that the whole 30 years. So they're making much, much more than the $483,000 that I already can see in front of my face will be paid. So now the sooner that you move some of this debt over to yourself in this example, this $377,000, the sooner you move some of this over to your own banking system, the sooner that you're going to be able to earn some of that 1.8 million, the more of that you're going to be able to keep in your own system, as opposed to willingly handing it away, never earning on it again, and letting the bank earn on it and make a whole bunch of money on it. So next time I'm going to be talking about compounding interest and uninterrupted compounding interest and just what all of that looks like. And so I hope that you'll join us for that. And up until then, if you'd like to connect to find out how infinite banking could work for you, what could it look like for your family or your financial needs, or maybe you have something you want to finance and take it over with your own banking system, reach out to me at Valerie@alphaomegawealth.com. So I look forward to sharing with you again soon. Have a great week.
This is thepodcastfactory.com.